Market Recap. I'm Daniel.
And I'm Mira.
Usually, when you look at global financial markets, there is, a certain predictable physics to it. If the literal engine of global trade, which is energy, starts catching fire.
And the currency, the world's fourth largest economy, goes into an absolute free fall. I mean, you really expect the stock market to reflect that gravity.
Exactly. You expect a flight to safety. When geopolitical alarms ring that loudly, the standard operating procedure is that risk assets sell off.
Right. Bond yields drop as people buy treasuries, and volatility just spikes.
But looking at the trading day we just had, it's like we're watching a complete split-screen reality. So, welcome to this deep dive. Today, we're unpacking Thursday, April 30, 2026.
And our mission today is to understand a market that is aggressively buying U.S. stocks despite, skyrocketing energy prices, a collapsing Japanese yen, and the White House overtly fighting the Federal Reserve.
Yeah, it's a lot to cover.
It is. But just as a quick reminder, before we really get into the mechanics of this split-screen reality, our mission today is strictly about market context and discussion.
Right, so no personal financial advice here.
Exactly. We're here to analyze the broader economic landscape, but this is not personal investment advice or a recommendation to buy or sell anything in your portfolio.
Absolutely. So let's jump right into session one. What set the stage before the U.S. session? Because frankly, global markets woke up to a massive financial earthquake today.
Yeah, they really did. And it actually started while most of the U.S. was fast asleep. The dramatic action kicked off overnight.
Right, the currency markets were just wild.
Oh, totally. At exactly 12:34 a.m. Eastern Time, the U.S. dollar surged past the historic 160 yen threshold. And, for context, Japan relies heavily on imported energy, which is priced in dollars.
So when the yen weakens past a huge psychological barrier like 160, the cost of keeping the lights on in Tokyo just skyrockets.
Exactly. It's a massive flashing red light for their entire economy.
And, the Japanese government didn't just sit back and watch their currency crater. They essentially stepped right onto the trading floor.
Yeah, Japan's top currency diplomat issued what he explicitly called a final warning.
Wow.
And shortly after that, the Nikkei reported a massive direct yen buying operation by the government.
Yeah.
When a government intervenes like that, they're essentially burning through their own foreign exchange reserves.
Just to artificially create demand for their currency.
Right. It's a brute force maneuver. And it worked temporarily. They forcefully pulled the currency back down to the 155 to 156.6 range. But it really highlights an extreme level of panic.
It's wild to see a major developed nation fighting the market like that. But, this currency stress is deeply connected to the paralysis we are seeing from European central banks right now.
Oh, absolutely. Early Thursday morning, both the European Central Bank and the Bank of England held their policy meetings, and they are completely trapped.
Yeah. I saw the Bank of England meeting at 7 a.m. Eastern Time. They held their rate at 3.75% in an 8-0 vote.
And shortly after that, at 8:15 a.m. Eastern Time, the ECB held its deposit rate steady at 2%. But, the decisions themselves weren't really the story. It was the tone.
Right. ECB President Christine Lagarde explicitly pointed to the Middle East conflict, driving a sharp surge in energy costs as her primary destabilizing factor.
And that Bank of England meeting is what really caught my eye. Governor Andrew Bailey presented these extreme scenario models.
Oh, yeah, the inflation models.
Exactly. He mapped out a situation where energy shocks could drive UK inflation up to a 6.2% peak by 2027.
Think about that for a second. We just spent years fighting inflation down, and now they're modeling a return to over 6%. It feels like central bankers are essentially just passengers in a car being driven by military generals right now.
That's a great way to put it. It is a stark realization of their limits. You can hike interest rates all you want to cool down consumer demand, but
you can't hike interest rates to pull more oil out of the ground.
Right. Policymakers are terrified of severe second-round inflationary effects driven by geopolitical supply shocks.
Which brings us to the physical anchor of all this panic, which is the Strait of Hormuz. By mid-morning, starting around 10:34 a.m. Eastern Time, Iran's supreme leader and their president released a series of aggressive statements.
Yeah, vowing to dismantle U.S. exploitation of the strait, they effectively declared a naval counterblockade.
And the maritime data confirms this is far beyond just mere rhetoric.
Oh, definitely. The U.S. military confirmed it had aggressively turned back 44 vessels in the strait today. And if you look at the shipping trackers, Iran's trackable oil exports are currently down over 80%.
Wow.
Yeah, we are looking at a physical chokehold on one of the most critical energy arteries on the planet.
So when I look at all these moving parts, it seems like both sides are using the physical energy supply chain as a bargaining chip. It's really geopolitical brinkmanship as game theory leverage.
Exactly. By choking the strait, you embed a structural risk premium into global oil prices. And that, in turn, forces Western central banks to deal with the economic fallout.
So to quickly synthesize the global backdrop before the opening bell, we had severe currency volatility in Asia, massive government market interventions, and European central banks practically paralyzed by energy-driven inflation fears.
All stemming from a physical naval blockade.
Right, so with all of that catastrophic gravity, you'd think the New York opening bell would trigger a massive sell-off. Which brings us to session 2. What moved markets during U.S. trading hours? Because, well, the U.S. market saw a completely different reality.
They really did. The tone shifted dramatically right at the 8:30 a.m. Eastern Time macro data drop. We received the advanced Q1 GDP numbers, which came in at a solid 2.0%.
So the domestic economy is still growing.
Yes. However, the inflation data buried inside that report was incredibly sticky.
Right. Core PCE prices, which we know is the Fed's preferred inflation gauge, jumped in advance 4.3%, with the year-over-year rate holding firmly at 3.2%.
And on top of that, initial jobless claims were shockingly low, at just 189,000.
When you look at 189,000 jobless claims, I mean, that is an incredibly resilient labor market. Employers are simply not laying people off.
Which means the U.S. consumer still has a paycheck, so they're still spending, which fuels that 2.0% GDP growth.
But here is where I kind of have to question the market's immediate reaction. The market looked at this data and just celebrated this no-landing narrative.
The idea that the economy won't even slow down.
Exactly. But looking at 189,000 jobless claims feels like we are looking in the rearview mirror. We have to remember energy shocks as a lagged consumer tax.
Oh, for sure.
I mean, consumers are paying for 105 dive WTI crude oil, which is what it closed at today after wild intraday swings. But this backward-looking Q1 data doesn't reflect that pain yet.
The lag effect is crucial. When gasoline prices surge, consumers don't stop driving to work immediately. They put it on a credit card or they cut back on discretionary spending elsewhere.
Right, and that shift takes months to show up in the macroeconomic aggregates. So the market might be overly optimistic by assuming the consumer is bulletproof based on Q1 data.
Especially when the Q2 reality involves 105 oil.
Yeah. But despite that lag energy tax, U.S. equities didn't just survive today, they rallied hard. The S&P 500 closed up 1% to 7,209.01.
The Dow surged 1.6% and the Nasdaq gained 0.9%. Across the board, buyers were completely ignoring the geopolitical risks.
Part of that domestic market optimism was heavily supported by some subtle but crucial diplomatic movements in the mid-morning, right?
Yes, at exactly 9:51 a.m. Eastern Time, there was a high-level call between Chinese Vice Premier He Lifeng, U.S. Treasury Secretary Bessent, and U.S. Trade Representative Greer.
And they formally agreed to continue their trade consultation mechanisms to manage differences.
Yeah. Now, impartially speaking, this was essential table setting ahead of the scheduled May 14 to May 15 Trump-Xi summit in Beijing.
So it provided a slight relief valve for global supply chain fears.
It's exactly. On a day dominated by extreme Middle East anxiety, the market really needed to know that the U.S.-China trade relationship wasn't simultaneously deteriorating.
But while international diplomacy was functioning, domestic politics were, well, boiling over. The Federal Reserve independence fight carried over heavily from yesterday's session.
It did. And just as a reminder for you listening, on April 29, the Fed held rates at 3.5% to 3.75% in a highly divided 8-4 vote.
That 8-4 split is the highest number of opposing votes since 1992. It signals immense internal disagreement about the path forward.
And the administration really pounced on that division today. Treasury Secretary Bessent went on record stating it would be highly unusual for Jerome Powell to stay on the board.
And then early in the afternoon, around 1:36 p.m. Eastern Time, White House economic advisor Kevin Hassett went as far as to call any rate hike a policy error.
So we have to analyze how markets digest this kind of pressure. And again, without taking political sides, you have to think about discount rates as gravity on valuations.
Right, the gravity to dollar.
Exactly. When you value a stock, especially a growth stock, you're estimating its future cash flows and discounting them back to today's value using the prevailing interest rate. The higher the rate, the heavier the gravity.
And the harder it is for high-flying tech stocks to maintain those sky-high valuations. So when the White House threatens the Federal Reserve's independence, they're essentially threatening to mess with that gravity dial in the middle of a market rally.
And the uncertainty over who exactly controls those rates becomes a massive looming variable for anyone trading U.S. equities.
Which makes the market's rally today even more bizarre. You have sticky inflation, a paralyzed Europe, a naval blockade, and the executive branch openly attacking the central bank. Yet the S&P 500 closed up a full percent.
So strong domestic growth basically offset all those fears of political pressure and inflation.
Right. Which leads us perfectly into session 3, corporate events recap and what to watch next. Because to understand why the U.S. market is shrugging off macroeconomic gravity, we really have to look deep into the corporate tech sector.
Yeah, the real hero keeping this market afloat is the mega cap tech balance sheet. To understand today's action, we have to bring in the earnings backdrop from the close of the prior session on April 29.
Right. We heard from Alphabet, Amazon, Microsoft, and Meta.
And the overarching theme across all of those reports was that massive capital expenditures are finally turning into hard, measurable operating data.
The Alphabet call was particularly illuminating. They noted that 60% of their technical infrastructure investment went directly to servers.
With the rest going to data centers and networking, they aren't just talking about artificial intelligence in abstract terms anymore.
No, they are out there buying the physical steel, the cooling systems, and the silicon, which perfectly sets up the standout corporate event of today.
Right before the opening bell, at 8:22 a.m. Eastern Time, Meta launched a $25 billion investment-grade bond sale.
A $25 billion debt offering is massive in its own right. But the astonishing part was the market's reaction. They drew $96 billion in demand from investors.
$96 billion in demand. That's just wild.
The credit markets are essentially handing these tech giants a blank check. When you see demand outstrip supply by that magnitude, it tells you that investors are treating AI capex as an existential arms race.
Oh, absolutely. The bond market believes these companies absolutely must spend tens of billions of dollars just to survive the next decade of the internet.
And clearly, investors are more than happy to finance the war effort.
The market is treating this corporate infrastructure spending as an independent economic cycle. The mindset is that it doesn't matter if the yen collapses or if oil hits $105.
Meta and Microsoft still have to build data centers.
Exactly. Therefore, the capital will keep flowing regardless of the macroeconomic headwinds.
But there is one specific area where this borderless tech expansion is slamming right into a brick wall, and that is national security.
Yeah, the situation with Anthropic today highlights this perfectly. This actually carries over from late evening reports yesterday, April 29.
Right. Anthropic, the major AI research company, is reportedly seeking a staggering valuation of $900 billion.
But they ran into a severe roadblock with the Pentagon. Anthropic proposed broadening commercial access to its Mythos model, but the White House actively stepped in to oppose that expansion.
And the rhetoric got incredibly heated. The U.S. Secretary of War publicly called Anthropic's leadership an ideological lunatic.
Wow.
Yeah, specifically regarding their boundaries on lethal decision-making.
Looking at this impartially, what we are witnessing is the inevitable collision between borderless tech valuations and strict national security guardrails. Wall Street wants these foundational models to scale globally to justify a $900 billion price tag.
But the defense establishment is making it crystal clear that dual-use technology, meaning AI models that have both commercial and military applications, will not be allowed to operate without strict military oversight.
It's a fascinating tension. The private sector wants infinite scale, and the public sector is demanding sovereign control.
It all adds to the surreal nature of today's market. In fact, we have a dedicated joke to summarize the absolute absurdity of the trading day.
Let's hear it.
Well, folks, the closing bell has rung on a day where the yen collapsed past 160, the Strait of Hormuz faces a naval blockade, and the White House is publicly trying to evict Jerome Powell. But who cares about global geopolitical instability when mega-cap tech companies are buying more AI servers?
Right.
The market's stellar performance today proves that as long as executives focus on artificial intelligence, the S&P 500 will magically go up. So grab a drink to celebrate your portfolio's victory today. Just make sure your beverage isn't imported through the Middle East, or you might have to liquidate your stocks to afford it.
Oh man, that's dark humor, but it perfectly captures the cognitive dissonance of the tape today.
It really does. So what should we be watching next?
Well, as we look ahead over the next 24 hours moving into Friday, May 1, there are a few critical data points you need to watch to see if this reality gap starts to close.
What's on the calendar?
First, at 9:45 a.m. Eastern Time, we'll get the S&P Global U.S. Manufacturing PMI final read for April. Shortly after, at 10 a.m. Eastern Time, the ISM Manufacturing PMI drops.
Okay, so these reports survey purchasing managers directly.
Exactly. So it will be a crucial, real-time look at how industrial supply chains are actually handling these energy and trade shocks right on the factory floor.
Got it. And then after the market closes, right at 4:15 p.m. Eastern Time, the Federal Reserve will release their statistical reports. We're looking for the G.5 foreign exchange rates, the H.15 selected interest rates, and crucially, the H.8 bank balance sheets.
That H.8 report is going to be heavily scrutinized. When you look at the H.8 bank balance sheets, you aren't just looking at generic cash reserves.
You're looking at commercial bank assets and liabilities.
Right, meaning you could see who is suddenly borrowing heavily just to keep the lights on. Given the currency chaos in Japan and rumors of emergency swap line requests, if there is hidden liquidity stress bubbling under the surface of the global banking system.
The H.8 report is where the bodies are usually buried. So, synthesizing everything we've covered today, I want to leave you with a final thought to mull over. Today proved beyond a shadow of a doubt that the U.S. equity market is currently existing in a completely different reality than global sovereign bond and currency markets.
Tech stocks are soaring on the promise of AI, while central banks are paralyzing themselves over naval blockades and energy shocks.
Right. The question for you to explore on your own is this. How long can corporate balance sheets outrun geopolitical physics before those two realities are forcefully forced to converge?
It is arguably the defining question of this entire market cycle. Thank you so much for joining us for this deep dive into the underlying mechanics of the tape. Let us know in the comments. Do you trust the economic data, or do you trust the geopolitical warning signs?